Okay, so if your investment plan involves generating income, you've probably been looking into European dividend ETFs, right?
Oh, absolutely. It's a huge market and, frankly, a bit of a minefield sometimes.
Yeah, exactly. Every asset manager seems to promise steady cash flow, reliable income,
Mhm.
but getting it wrong, falling for a yield trap versus finding, real quality income, that difference can mean hundreds of thousands of euros over your investing lifetime. It's huge.
It really is.
So the sources we looked at today, they basically give us a blueprint for smarter income investing, specifically for us here in Europe.
That's a good way to put it.
Our mission in this deep dive is really to pull out those key strategies, cut through all the marketing noise, and give you that shortcut to understanding where the real value is.
And importantly, where the hidden risks are, especially on the tax side.
Definitely. Those hidden tax risks.
Yeah, the research we've analyzed, it's designed to help you avoid those common, often quite emotional mistakes investors make.
Like chasing yield. Exactly. Moving past those tempting headline numbers to build something, genuinely solid, a portfolio that grows properly even after you factor in European taxes.
Okay, let's unpack that straight away.
Yeah.
The number one mistake, the
Yeah.
one our sources really hammer home,
Mm-hmm.
it drives so much underperformance. Just focusing purely on the high dividend yield, you see that like 6% or 7% advertised.
Yeah, and your eyes light up. Instant cash flow, right?
Totally.
Yeah.
Well, why is chasing that high yield so often?
Uh-huh.
Well, why is it like investment junk food?
Uh-huh. Yeah, it's the classic bait. It appeals to that immediate gratification instinct. But the core problem, the yield trap mechanism, it's actually pretty simple.
Okay.
When a stock price falls sharply, its yield automatically goes up mathematically. Price down, yield up.
Right. Even if the actual dividend payment hasn't changed.
Precisely. So investors see this high percentage, maybe 8%, 9%, and think, wow, that's healthy. But often it's the exact opposite. The market is already pricing in distress. So the high yield isn't a sign of strength. It's more like a flashing red light that the market's punishing the company.
That's often the case.
Yeah.
Yes. And the source data is really clear on this. Chasing yield without looking at the total return.
Meaning the share price growth plus the dividends?
Exactly. If you ignore that total return, you're almost guaranteed to underperform the broader market indices over the long run, like decades.
So you might get that juicy 7% dividend for a bit.
Right, but if the market thinks that dividend is shaky, maybe the stock price falls 8% that year, you've actually lost money overall.
A net loss. And you gave up potential growth elsewhere just for that dividend.
And what's really damaging, the sources point this out, is the potential for a kind of double whammy.
Okay.
These struggling high-yield companies, they're often the first in line to announce dividend cuts when things get tough.
Ah, right.
So first, you lose capital as the stock price drifts down because of the company's problems. Then, boom, they cut the dividend, and the stock price crashes even further.
Ouch. So you lose the income you were chasing and a chunk of your capital.
Exactly. Both. That's the yield trap snapping shut.
Okay, that makes it crystal clear. Total return is the only metric that really matters long term.
Mm-hmm.
Sacrificing capital growth just for today's attractive dividend yield. That's a mathematical hole that's really hard to climb out of over, say, 20 or 30 years.
Absolutely. You have to prioritize the underlying health of the business, not just the size of its current payout.
Right. So if yield chasing is trap number one, trap number two is more subtle, maybe. An operational killer, as the sources put it.
Yeah.
And this one's super critical for European investors.
Yes. Tax, specifically the tax implications linked to the ETF's structure.
This is where geography really bites, isn't it?
It absolutely does.
Mhm.
The choice you make between a distributing ETF that's the D share that pays out cash dividends
Okay.
versus an accumulating ETF, the A share, that reinvests dividends internally. That choice might be the single biggest lever for your long-term compounded growth in Europe.
Why is such a big difference?
Well, in almost every major European country, those distributing ETFs are, frankly, a tax nightmare, especially if you're younger and still building wealth.
Nightmare how?
Every time that cash dividend lands in your brokerage account, boom, it often triggers an immediate taxable event.
Right now. Instantly.
Often, yes. And it can be taxed at your highest marginal income tax rate. Think 30%, 40%, sometimes even over 50%, depending on where you live.
Wow. So a huge chunk is gone straight away.
Gone. before you can even reinvest it. It massively cuts down the amount of money you actually have working for you and compounding over time.
It's like you're, I don't know, deliberately slowing down your own investment engine every few months just to get a small cash payout.
That's a perfect analogy. You're paying tax today on money you probably don't even need to spend yet.
So what's the alternative? The accumulating ones.
Exactly, the A shares. That's the solution strongly recommended by, well, all our sources, because the dividend gets reinvested inside the fund itself.
Ah, so it never hits your personal bank account.
Correct. Which means you defer the tax, potentially for decades, until you actually sell the ETF units.
Okay, let's make that concrete. Give me an example.
Sure. Let's say you're in, I don't know, Germany or Spain. You get a 3% dividend from a distributing fund. Your tax rate on that income might be 35%.
Okay.
You lose over a third of that dividend instantly to tax. Gone. With an accumulating fund holding the same stocks, that 3% gets reinvested pre-tax. You defer that 35% tax bill until you sell maybe 20, 30 years down the line.
And when you do sell, you might pay a lower capital gains tax rate anyway?
Potentially, yes. Many countries have lower, flatter rates for long-term capital gains compared to income tax. That tax deferral plus potentially a lower rate later. That difference, compounded year after year, adds up to thousands, potentially tens of thousands of euros more in your pocket.
Okay, that's compelling. But let me push back a bit. Play devil's advocate.
Go for it.
What about retirees? People who actually need that income stream now. Isn't it just easier to get the cash from a distributing fund, even if it's less tax efficient? Selling bits of an accumulating fund every quarter sounds fiddly.
That's a very fair point, and the sources do tackle it. For someone in retirement, drawing down their savings, the decumulation phase, as it's called.
Yeah.
Okay, maybe the D-share offers some psychological comfort, simple cash flow, but mathematically, the recommendation often still favors the accumulating structure.
Even for retirees?
Often, yes, or at least a specific type of factor-based fund that minimizes tax drag. The reason is control. Even for retirees, tax planning matters. Selling a specific number of units from an accumulating fund each quarter.
They call that synthetic dividends, right?
Exactly. Creating your own income stream. It lets you control the timing and the amount of the taxable event. With a D-share, the fund manager dictates that every quarter, whether it's convenient for your tax situation or not.
Okay, that reframes it. So you gain control by selling accumulating units, potentially optimizing tax even in retirement.
Precisely. So the big pitfalls are clear. Chasing yield, which hurts total return, and using tax-inefficient distributing funds, which kills compounding.
Got it. Yield obsession and the wrong structure. So we know what not to do. Where do we go from here? What are the better strategies, the ones the sources actually promote?
Right, so we move away from just gut feelings and simple screens towards more evidence-based approaches, specifically factor investing.
Factor investing. We hear that term a lot.
We do, and the sources really zero in on two factors in particular for income seekers: value and quality income.
Okay, let's define those quickly for everyone. What are value and quality income actually looking for in a company, and why is that better than just picking the highest yielders?
Sure. So a basic high-yield screen, as we said, it's just math. Dividend divided by price. Simple. Factors dig deeper into the company's actual characteristics. It's DNA.
Okay.
The value factor looks for stocks that seem cheap compared to their fundamental worth. Things like a low price-to-earnings ratio or low price-to-book value. Essentially, trying to buy good companies when they're on sale.
Finding a bargain. Makes sense.
Then the quality income factor focuses on the sustainability of that dividend. Is it safe? It screens for companies that are financially strong. Meaning high profitability, strong free cash flow generation, manageable debt levels, a solid balance sheet. Basically, filtering out the financially shaky companies that might have to cut their dividend later.
Ah, so avoiding the potential yield traps we talked about earlier.
Exactly. By combining these two factors, value and quality, you're aiming to buy robust, durable businesses at a fair price. And history shows that combination tends to lead to better long-term results.
So you're not just grabbing any old stock paying a dividend. You're specifically targeting companies where that dividend looks secure because the underlying business is strong and maybe even a bit undervalued.
That's the idea. These strategies systematically screen out many of the companies likely to fall into the yield trap. You know, the ones with weak profits or tons of debt that get crushed in a downturn.
Which is why they often outperform.
Correct. The value and quality filters help you capture a potentially attractive income, yes, but alongside better odds of long-term capital growth because the companies themselves are just more resilient, less likely to blow up or slash their payouts.
And this isn't just some academic theory, is it? The sources mention real-world examples.
Absolutely. They point out this factor approach is used globally. European fund managers are increasingly creating ETFs that mirror the kind of factor screening used by popular U.S. funds, like SCHD or JPQ.
So even though the specific funds available here are different, the underlying strategy screening for quality and value works across markets.
It seems to, yes. The key for you, the listener, is to look beyond just the basic country index funds like the FTSE or DAX trackers.
You need to dig deeper.
You need to look for indices or ETFs here in Europe that explicitly state they screen for these factors. Look for keywords in the fund name or description like quality, value, low volatility, maybe fundamental. Those funds are specifically designed to capture those potential return premiums linked to safety and relative cheapness, wherever the underlying companies are based.
Got it. So let's try and pull this all together, the essential playbook from the sources.
Okay, synthesis time. First, override that gut feeling, that emotional pull towards high yield. Focus ruthlessly on maximizing total return.
Total return, number one.
Number one. Second, taxes, taxes, taxes. Prioritize tax efficiency. For most people building wealth, that means choosing accumulating funds, A shares, to let that tax deferral work its magic.
Accumulating for compounding.
Got it. And third, use proven factor strategies. Specifically, look for funds incorporating value and quality income screens to find companies with sustainable dividends and better long-term profit potential.
Okay, that's a clear three-step plan. Avoid yield trap, use accumulating, focus on quality and value factors.
That's the core of it.
But this brings us back to something you touched on earlier, something the sources really highlight. The stark fact that so many plain vanilla high-yield funds actually underperform the broad market indices significantly, even before you account for the tax drag from distributing structures.
Yes, that underperformance is often quite striking in the long-term data.
So given that,
Yeah.
maybe the final question isn't just about which dividend strategy is best, quality, value, whatever.
Okay, where are you going with this?
Well, maybe the bigger question you need to ask yourself is whether focusing on income generation at all, even using these smarter factor approaches, whether that focus justifies potentially missing out on the higher total returns you might get from just a simple broad market index fund.
The ultimate opportunity cost question.
Exactly.
Do you optimize for income generation, potentially accepting a slightly lower overall return ceiling? Or do you go all in on maximizing total return with a broad market tracker, planning to sell units whenever you need cash?
One path optimizes mathematically, maybe.
While the other might offer more, shall we say, psychological comfort. That feeling of receiving passive income payments regularly. It feels safe, predictable, even if the total growth isn't maximized.
Right. And the sources seem to suggest that for many long-term investors, the strong preference for dividend income is often more about that feeling, that financial comfort zone,
Yeah.
than about pure mathematical optimization for wealth creation. Yes, that's a strong theme.
So it's a really profound question that shapes your whole investment approach, isn't it? Are you building your portfolio purely for the best possible numbers on the spreadsheet? Or are you optimizing for, well, sleeping well at night?
Math versus peace of mind. It's a fundamental choice.
A choice only you can make. And that's the thought we'll leave you with today as you think about building your own winning strategy.